Hi, everyone. So welcome to the stream today. Very much excited for having you on this special Q&A session with me. Today, we are focusing on management accounting and strategic case study. And for those of you who are here on the Zoom meeting, you can please note that we are streaming live on YouTube. So in case you don't want your background to show, you can turn off your camera. For those of you watching on YouTube also, you can comment in the chat box with all of your questions. I'll be addressing all questions. We are focusing today on management accounting and then strategic case study. Now, if you're watching on YouTube and you want to join the Zoom meeting, the meeting ID is in the chat box and you can check it out and then you can join the stream here on and ask your questions in relation to that. So if you join the stream here on Zoom, you turn off your mic, and then if you have any questions, you raise your hand, like you click on the raised hand button, and then I'll call you. Then we will take your questions in relation to that. Now, for those of you watching on YouTube, give us a thumbs up on the video and share it as well with your colleagues, your friends, and loved ones. We want to get as more engagement on the video as possible. That is how YouTube will be notified, so they can push the video to reach as much people as possible in relation to that. Okay, so I see some comments on YouTube. Hamdul Abad, great. I will join as soon as possible. Sami is watching with you. Okay. Great. Very smooth. Enjoying it here. Okay, that's okay. Right. So for those of you who are on the Zoom, I see Fianyeku, Kofi, and then Techno Spark. If you have any questions, you can get it up straight. You can raise your hand, click on the raise your hand button, and I'll call you and you come in with your questions. If you are watching on YouTube as well, comment in the chat box with all of your questions. All right, Augustine A. Barton, good evening. I believe you are doing well from the New York City. Thank you for joining us. Today we are focusing on strategic case study and management accounting. So if you have any questions, you know what to do. Put it in the comment box for those of you who are on YouTube. And then for those of you on the Zoom call, you can indicate by raising your hand and I'll call you to answer or to ask your questions, and I'll be answering them for you in relation to that. Okay, others are joining the stream here on Zoom. Okay, Samuel Corte is here. Oh, okay. Sesame, thank you for joining us today as well. So we've started. If there are any questions, for those of you watching on YouTube, you comment below with your questions. I'll be addressing all of your questions for you. For those of you who are with me on the Zoom call, you can indicate by raising your hand and I'll call you for. Okay, some of all the for this combination is the uh, topics that are related in man accounting and strategic case study. We have issues like ethics, which is in management accounting and it's in strategic case study. We have issues like investment appraisal, which is in management accounting and is also in strategic case study. Then we have issues such as, give me a moment, performance measurement, which is in management accounting, as well as in strategic case study when we are assessing performance of organizations, and budgeting, which is also something that is critical when it comes to management accounting. So that is why we decided to merge these two subjects together on the stream today. So for those of you watching on YouTube, comment below in the chat box with all of your questions. And you can also join the Zoom and ask your questions directly using the meeting ID provided in the chat box. Okay, let's see what we got here. All right, so Fianyeku, Joseph Edu, Techno Spark. I think these are the people who are on the Zoom call now. If you have any questions, you indicate and I'll call you and you can ask your questions in relation to that as we get connected on the other places. All right, so when it comes to the issue in relation to management accounting, so I'm just going to be sharing a couple of things with you as you comment below with all of your questions. Now, like I said, for those of you on the Zoom call, you can indicate by raising your hand, click on the raise your hand button, and I'll call you for you to ask your questions. For those of you watching us on the YouTube also, what you can do is to comment in the chat box with your questions. I have another screen here that will enable me to be able to read your comments in real time as I'm talking. Now, like I said, for those of you watching on the YouTube, you can indicate by raising your hand, click on the raise your hand button, and I'll call you for you to ask your questions. Okay. So when it comes to the issue about management accounting, one of the questions I get asked a lot of time is, okay, Nhyira, how do I pass management accounting? And it's very important for you to always understand the scope of the subject, what the subject represents, what are involved in the subject, what the subject actually covers, and the key areas that you have to focus on in order to increase your chances of ultimately passing the examination. So the question we then ask ourselves is, all right, how do we position ourselves to pass the management accounting exams? And how do we, or what areas do we focus on in order to maximize the marks in the exam hall? Now, like I say all the time, there are two stages of preparation that you got to understand. The preparation you do, or you put yourself through before you get to the exam hall, and what you do in the exam hall to actually be awarded the pass mark in relation to that. So prior to the examination, what you've got to be doing is to be able to study, be able to understand the subject, be able to understand Okay. Well, that's like Our network is already messing us up. But I think we are okay now. So what areas do we focus on? What areas do we look out for whilst preparing for the exams in relation to that? Now, as always, you must understand the structure of the examination. So when we say understanding the structure of the examination, what do we mean? So if it comes to management accounting, for instance, you realize that there are a couple of issues that you have to understand. Okay, I see a comment, maybe a question actually on YouTube from Augustine A. Boatin. He said, please throw a bit light on cost control and cost reduction. Okay, now cost control and cost reduction are two things quite different. Now the idea is this: cost control has to do with the measures put in place by an organization in order not to incur costs outside the budgeted cost. So in controlling of cost, what happens is that the organization sets the budget or sets the standards, and then will measure the actual performance. And as and when we are implementing the budget and we are going through, the organization will be comparing the actual with the budgeted so that we don't spend more than the actual in relation to that. That is the idea about cost control. So making sure that we are within the budget or spending within our budget. But when it comes to cost reduction, it's a mechanism put in place in order for the organization not to incur more costs. Now, let me explain that. For instance, if we're producing a product and we need a material to produce the product, and we've budgeted that we want to spend $1,000 on the material. And whilst we were going to buy the material, we have two options. We could buy 1,000 units and get a discount, or buy 200 units and not get any discount. So what do? As an organization, we want to find out how do we reduce our cost. So if we can buy 1,000 units at a go, so at each order, we can buy 1,000 units and enjoy a discount, then when we are buying, we will rather buy the 1,000 units rather than the 200 units, which will make us to be incurring more cost. So that kind of strategy, that kind of technique, that kind of decision is a cost reduction strategy. Now remember, the fact that an entity is trying to reduce its cost does not mean that it is substituting quality for the price or for the cost of the product. So cost control has to do with comparing your actual against your budget in order to ensure that you are not overspending per the budget. Whilst cost reduction is the decisions, processes, or procedures put in place by an organization in order to reduce the cost incurred in an effective and efficient way of an organization. So Augustine A. Boatin, that is the difference between the cost control and then the cost reduction. So if you are watching on YouTube, please give us a thumbs up on the video and share it if it is possible for you to share it, which is possible, so that the video will be engaged and YouTube will see that, will be able to pull it up and then send it to a lot of people to watch as well in relation to that. Now, for those of you watching who are with me here on the Zoom call, you can indicate if you have any question by raising your hand on the reaction button. I don't know. Let me confirm where that is. Okay, I think the more button, you will see a more button there. So on the more button, you click on raise hand and I will get the indication that you raise your hand and I'll be able to answer any questions that you have in relation to that. Okay. My network is not as stable as it's supposed to be, but I think it's okay now. We can continue. So YouTube, comment below with your questions in the chat box. I'm reading all of your comments. Give us a thumbs up as well on the video on YouTube, and I'll be answering all of your questions for you. Rubin Blonya, Nhyira, thank you. You are welcome, Rubin Blonya. This is on YouTube. So if you have any questions or you want to join the stream on Zoom and ask any questions directly, you can take the meeting ID. It's in the chat box there. You scroll up a little bit, you will see the meeting ID and you can join me and ask any questions that you have. Right, so I was talking about management accounting and I mentioned that there are two things you've got to understand. What you do before the exams and what you do in the exam hall. So the key question we ask ourselves is, all right, what are the key areas we have to focus on when it comes to management accounting? To be able to answer that question, we will first have to understand what is the structure of the syllabus. So once we know the structure of the syllabus, then we will be able to answer that question in relation to that. So when it comes to the structure of our syllabus for the management accounting, among other things, the first thing we see all the time is going to be the contemporary issues in management accounting. The contemporary issues. Now, under this segment of the syllabus, which is contemporary issues, there are a couple of things there that you have to understand, like ethics. And we've spent some time to discuss the issues about ethics. I think last week or last 2 weeks, I discussed the issues about ethics where we explained the fundamental issues, the fundamental codes of ethics, like integrity, professional competence and due care, confidentiality, professional behavior, all of those things are the ethics. These are there. You must make sure you understand them. Then value chain analysis. This is another module that you must understand. Now, this module is also in strategic case study. So you see why we merged the two to discuss today. And then, now what is the value chain used for? The value chain is used for identifying the activities that actually add value to the input of an organization. Now, the reason why an organization would want to perform or use a value chain analysis is to be able to identify which activities are core that it has to focus on and which activities are non-core that it may want to outsource to another organization. But with the world that we live in now, even if we undertake a value chain analysis, and we realize that there are some activities that are critical, that are fundamental to our operations as an organization, it will still be possible to actually outsource even some of our core operations as an organization. Nonetheless, it is something that we carry out there. Then the next thing has to do with assessing an organization's performance. And as part of the contemporary issues, one of the things that we got to understand is the issue about the balanced scorecard, which we have also spent some time to look at over the period. Let me just see and spell this well. The balanced scorecard. So this is also another key module by Kaplan and Norton. Now, the balanced scorecard It's also a key module you must understand if you are writing strategic case study. Where we are assessing the organization's performance from 4 perspectives. That is, we're looking at the issue in relation to financial perspective. That is, how do we appear to our shareholders? Customer perspective, how do we appear to our customers or satisfaction of customers? Then internal business perspective, that has to do with the efficiency and effectiveness of our internal controls as an organization. Then the issue in relation to learning and innovation, whether we are improving ourselves as an organization during the year under consideration. So that is also another key module that we must understand when we are dealing with the issue in relation to management accounting. And like I said, this is also in strategic case study in that case. So aside these 3 key modules, there are other issues that we have to talk about in relation to the contemporary issues. And this will include things such as throughput accounting ratio, environmental accounting. So throughput accounting ratio, let me just use the mnemonic, throughput accounting. So it's another key area that we would have to look out for. Then certainly when you are dealing with throughput accounting, the issue about limiting factor analysis must also be on your mind. So if an organization wants to produce a product or render a service, and at the end of the day, the product it is producing or the service it is rendering, there is limited availability of resources, what do we do? How do we do it? Or how do we go about it? So that's where we're going to be using the limiting factor analysis. Now, remember that when we are using limiting factor analysis, there are 2 schools of thoughts under that. We can use the marginal costing principle, which is the traditional approach, where we say selling price minus variable cost to get our contribution. And then once we get a contribution, we calculate the contribution per the limiting factor. Then we will use that to rank the product. Then we will decide which product to produce first in order to design a production plan. Then aside marginal costing being the traditional approach, another thing that we can talk about in relation to the limiting factor analysis is to use the throughput concept. We could also use the throughput concept. So the organization can also use the throughput concept in order to determine how we can design a production plan for an organization. Now, all these things are in the contemporary issues in management accounting in relation to that. So once we deal with the throughput accounting ratio, limiting factor analysis, like I mentioned, another issue in the contemporary issues in management accounting is environmental accounting, how we incorporate the effect of environment or the environmental issues on the financial statement of the organization. So that is also something we have to look out for in relation to that. So if you put it in a nutshell, you realize that value chain analysis, ethics, balance scorecard, throughput accounting ratio, limiting factor analysis, environmental accounting, these are key issues that we have to talk about when it comes to the contemporary issues in management accounting. So once you deal with the contemporary issues, now for those of you watching on YouTube, you can comment in the chat box with all of your questions. I have another screen here and I'm reading all of your comments live and I'll be answering them. So whatever questions you have, you comment below with your questions. Then for those of you who are on the Zoom call, if you have any questions, you click on the more button on your device and you will see raised hand. And when you click on that, I will be able to get an indication that you raised your hand. Then I'll call you in to be able to answer your questions for you. Now, remember, this is a Q&A session. I'm not really here to teach. I'm here to answer your questions for you. So if there is anything you don't understand, anything you want some clarity on, like Augustine asked a moment ago on YouTube, you can just indicate it and I will be able to answer that for you in relation to that. So that is what you have to understand when it comes to the first aspect, which is the contemporary issues in management accounting. Now, after the contemporary issues in management accounting, we now come to the issue in relation to short-term decisions. So here we're talking about issues such as make or buy, shutdown decision, break-even analysis. All of these things are part of the short-term decisions where we are going to be using the marginal costing principle, which means that we're going to be focusing on contribution being equal to your selling price minus variable cost to make all those various decisions for the organization in relation to that. So it's very, very important for you to understand all the concepts there, make or buy, then relevant costing analysis. This is also something that is critical that you must understand. So for instance, if a company receives a special order, like let's say I'm an event organizer and someone invites or an artist come to me and say, Nhyira, I want to organize an event at the Independence Square. How do I determine how much I will charge that artist? That is under relevant costing. Or I'm a teacher. Someone comes and says, Nhyira, I want you to teach me 2 weeks to prepare for my MBA exams. Okay, what would determine how much I will charge such a person? The way or the technique I will use to charge such a person is relevant costing principle, where I will just consider the relevant cost I'm going to be incurring, the incremental cost I'm going to be incurring in undertaking the project or in rendering the service in relation to that. And that will now guide me to be able to determine how much I will charge the person in relation to that. And make sure you keep in your mind this, that when it comes to relevant costing, we deal with relevant cost. Now, if we are dealing with relevant cost, opportunity cost is a relevant cost, incremental cost, specific fixed cost, issues in relation to incremental cost must all be or are all relevant costs. It means such issues such as sunk cost, committed costs, all right, general overheads, absorption of overheads, all these are irrelevant costs. But as always, the examiner is going to put you in the spot or on the spot where these things may be included, but if you're not careful, you are going to be including them in the determination of the cost of the product or the service under standard relevant costing analysis or a special order or a job costing order in relation to that. Hi, Samuel Quasin. I see you on YouTube. You are welcome. We are focusing today on management accounting and strategic case study. So if you have any questions, anything you want me to share my thoughts on or to answer, you can comment below with your questions in the chat box. And I'm going to be reading all of your comments and answer all of your questions for you in relation to that. Then those of you on the Zoom call also, you can indicate if you have any questions by raising your hand. On the more button, you will see raised hand. When you click on that, I'll get a notification and I'll invite you to ask your questions. Now, for those of you watching on YouTube, I'll be very much grateful if you will give me a thumbs up on the video. So just give me a thumbs up on the video to make it engaging so that YouTube will be able to push it to other people to watch so we can get more people coming on the stream. So for those of you watching on YouTube, give me a thumbs up. Give me a thumbs up on the video. Give me a thumbs up and let's make it engaging. And whatever questions you have, put it in the comment box. Remember, this is a Q&A session, okay? So don't allow me to be the only person talking. This is a Q&A session and I would want to be able to answer all of your questions for you. Okay. Okay, some people are joining on the Zoom call. Okay, their devices are being connected. Right, so that is it about relevant costing. It's a very key area that we would have to focus on once we are dealing with management accounting, because the examiner is highly likely to be able to throw you something there in relation to that. Prince Morris and then Victor Drocor on, forgive me if I don't mention your name right, okay? If you have any questions, you can click on the more button, you will see raise hand, and you can raise your hand and then you can ask your questions. When you raise your hand, I will call you in, then you can ask your questions. We are focusing on management accounting and strategic case study today. So whatever questions you have, I will be able to answer them for you. In that case. Right, so after you deal with all of these issues about short-term decisions, then we come to also some long-term decision stuff. We come to some long-term decision stuff. Now, in the long-term decision aspect, what we're talking about traditionally is the issue about investment appraisal. But this is one good news, or one thing you must understand. When it comes to management accounting, you may go to the exam hall and you may not see any question on investment appraisal. If you don't see any question, don't take it personal. It can happen. So in that case, if there is no question on investment appraisal, then the examiner may bring 2 extra questions on short-term decisions in relation to that. So if the examiner wants to really exploit, or let me not use the word exploit, the examiner wants to really test students' understanding when it comes to short-term decision making, because which is the fundamental aspect for management accountants, he would want to ignore investment appraisal and bring maybe 2 questions on short-term decisions in relation to that. But investment appraisal is one of the key aspects in that case. I see another comment on YouTube. Let me read that out. Augustine A. Boatin said, does notional interest or imputed interest considered relevant in relevant costing? Sometimes I get confused about it. No, in relevant costing analysis, we consider the interest we will pay if we are going for a loan to finance the deal. So like I said, if you employed me or you said, Nhyira, teach me, and for me to be able to teach you, maybe I need to get a device. So I want to go and buy I got to buy a new device. And to buy the new device, I need a loan. So I go to the bank for some overdraft short-term loan, maybe to buy the device. You know, I'm using short-term loan to buy fixed assets. It's not good, but I'm just using it for example. So I go for the short-term loan. The interest that I'm going to pay on the short-term loan, I will factor it as relevant costing. But notional interest, that is the interest on investment, that one will not be considered as relevant costing. But if we go to borrow some money from the bank in order to finance what we are doing, then the interest on that money we've borrowed from the bank, that short-term period to undertake the project, will be considered as relevant when we are preparing the relevant cost sheet. So Augustine A. Boatin, that is the answer. Notional interest, no. The returns that investors will want or providers of finance will want, we will not consider that. But if we go and borrow any money for the sake of the job we are undertaking, then we can factor that in relevant costing. So I believe that your confusion has been solved now in relation to that. Right, so let's get back to investment appraisal. Okay, I see Techno Spark 2 raising your hand, so you can unmute your mic and then you can talk.
Hello. Hello.
Techno Spark 2, I'm listening.
Can you hear me now?
Yes, I can hear you.
Hello? I said I want to help me with the concept of efficiency ratio, capacity ratio, and production volume ratio. There was a
I'm
question in
coming.
November 20.
I'm now finding it difficult to hear you. I don't know. Maybe your network, it's not so good. Okay, your network too is okay. Okay, so speak again and let's see.
I'm saying I want you to help me with the explanation of efficiency ratio, capacity ratio, and the production volume ratio.
Yeah, go ahead. You can mention your name and then you go ahead.
Yeah, my name is John Adu. John Adu.
Sorry?
John Adu. Adu. John Adu. My name is John Adu.
Okay.
Adu. And I'm saying I want you to help me with the explanation of efficiency ratio, capacity ratio, and then production volume ratio.
I didn't get that well. The last part.
Production volume ratio.
Production
Efficiency.
volume ratio.
Yes.
And then
production. I mean efficiency ratio.
Let me see if I can
And then
get. I'm coming. Let me see if I can adjust my sound a little bit because I'm finding it quite difficult to hear you. Let's see. Okay, so try to speak again and let me see.
Okay, so my name is John Adu.
Okay, John Edu.
Yes, please.
Yeah, John.
And I'm saying I want you to help me with the explanation of capacity ratio, and then production volume.
Capacity ratio.
The efficiency ratio.
Efficiency ratio.
Production volume ratio.
Okay. So I think I get you now, John. Victor, I see your hand up. Let me answer John's question and then I will be able to answer your question for you in that case. Now, so when it comes to accounting for labor, one of the things that comes up is the issue in relation to capacity ratio and then the efficiency ratio. The capacity ratio has to do with how many outputs that the employees can produce within a given period of time under consideration, whilst the efficiency ratio has to look out for how many hours they are using to produce that output as compared to how many hours they are supposed to use in the production of that output. So the formula, so let me use the formula so I can illustrate that to you here. Let me open my slide on that. Let's see what you got there. So give me a moment. I have that. I have some of these things off head for me. So let me just cross-check the formula so we go. I guess I'm here now. Accounting for material. Good. So let me write it at the back. So our capacity ratio equals the actual hours worked divided by hours budgeted, whilst efficiency ratio equals the expected hours over actual hours. Note that the capacity ratio times the efficiency ratio gives us the production volume ratio. So remember what I said. When we are dealing with the efficiency ratio, we are comparing the expected hours to make the product against the actual hours that was used to produce the product. So for instance, if we expected you to use 5 hours to make a product, and then you actually used, let's say, 6 hours to make the product, that means your efficiency level is going to be something like 0.9 something. So it means you are below. But if you take, so you're supposed to, we expect you to use 5 hours, but you use 6 hours. It means you're not efficient. But if we expect you to use, say, 4 hours, but you actually use 2 hours, it means that you are more efficient in relation to that. So while the efficiency ratio is measuring how many hours you use to produce the output as compared to the hours you were supposed to use, the capacity ratio is measuring how many hours that you take to produce the total units as compared to the budgeted hours that we have in relation to that. So that is the capacity ratio, the actual hours you worked over the hours budgeted, and the efficiency ratio, the expected hours over the actual hours taken. Like I said, when you multiply these two, it gives you the third question you ask, and that is going to be the production volume ratio. But we can say the production volume ratio is the output measured over output measured in standard hours divided by the hours budgeted. So that is the difference between these three. This is looking at your efficiency level. Did you work less than the hours we expected you to work? Whilst this is looking at how many hours you work as compared to how many hours that we have budgeted for you in relation to how many hours you are supposed to work in relation to that. So Edu John, that is if I heard your name right, are you okay with the explanation of these three things you asked?
Yes, please.
Okay.
Okay. Thank you very much.
Victor. Victor Droko. Forgive me if I don't mention your name right, okay? You can unmute your mic and talk.
Victor Droko.
Okay, Droko, sorry.
Good evening, sir.
Yeah, good evening. How are you?
I'm fine, sir. Actually, I didn't start early with you, sir. But I want some explanation on material mix variance and material yield variance. For that one, I don't get it right. If you can elaborate it more for me, sir.
Okay. Now, for those of you watching on YouTube, comment below in the chat box with all of your questions. I'm reading all of your comments here to be able to answer, and give me a thumbs up on the video. Okay, so we get it more engaging in relation to that. Okay, so Victor, I'm going to stick to your first name. When it comes to variance, standard costing and variance analysis, one key thing is the direct material cost variance. So when we are dealing with the direct material cost variance, two things in general, we deal with the direct material usage variance and then the direct material price variance. This is not your question, but I'm building it up for me to get to where you are. Now, under the material price variance, this is based on the actual material we've bought. And so we can break this down into what is called material price planning variance and then material price operational variance. So these are two breakdowns we can have for the direct material price variance. That is not your question. When it comes to the material usage variance, when an entity is producing a product and it uses more than one material, then the examiner will throw a jab at us and will ask us to compute material mixed variance and then the material yield variance. So the question we then ask ourselves is, what is the mixed variance? What is the yield variance? The mixed variance has to do with the standard mix of the products or the materials in getting the actual units that we have produced, whilst the yield variance is the output that we are actually having. So to be able to explain this for you better, I'm going to use a guinea pig question to draw your attention on the distinction well. So let me give you a scenario here. So let's say this is our standard cost sheet right here. So let's say on the standard cost sheet, we have two types of materials. So let's say material A and material B. So let's say that on the standard cost, we have 11 kilograms at $2.5 per kilogram, and then 13, or let's just say 8 kilograms at $3 per kilogram. Then, now 11 by 2.5, what do we have? 11 times 2.5, that should give me $27.5. And then 8 times 3, that will give me $24. So this is my standard cost sheet. Follow me carefully. Now, let's say that on the actual results for the period, it's as follows. So the actual results is that with the material A, we used 3,000 kilograms. Material B, we used 8,200 kilograms. And we used this and we bought them at, let's just say, 36,000 and let's say 56,000. Now, let's say the actual units produced was 1,000 units. Now, this is our question. And the requirement is we should calculate the material mix and material yield variance. So how do we go about it? Very simple. Like I said, the mixed variance looks at for the two materials that has been used actually to produce the actual unit of 1,000, how should it have been used? So this is the pro forma. We're going to put material A here, put material B here, put the total here. Then we will bring standard mix in actual mix. Then we will bring actual mix in standard, actual mix in actual quantity. Now this is standard mix in actual quantity, and then actual mix in actual quantity. So follow me carefully here. The way you do the mix variance is that you go to the actual results and pick the actuals. The actuals is the actual mix in actual quantity. So material A, 3,000. You don't think about it. Material B, 8,200. Then you add the two up. When you add the two up, it is going to give me 11,200. Then you will put that 11,200 at the total column for the standard mix in actual quantity. 11,200. Then to get the standard mix in actual quantity, how do you go about that? This is how you go about that. If you look at the standard cost card, you realize that for each unit of the product, we want to use 11 kilograms of material A and 8 kilograms of material B. So we add the two up, and that's going to give us 19. So we use that 19 as a proportion to share this one. So material A is going to be 11 over 19 times this, and material B is going to be 8 over 19 also times this. That is how you get the standard mix in actual quantity. So let's punch it out and let's see what we have. So 11, you can confirm as well, okay? Over 19 times 11,200. That's going to give us 6484 approximately. And then 8 over 19 times 11,200. That's going to be maybe 4716 approximately. So what do we have here? You will see standard mix in actual quantity and actual mix in actual quantity. Now, when we say standard mix in actual quantity, what do we mean? We mean that for the total actual units that has been used, based on our standard, material A should have been 6,484. Material B should have been 4,716. But what was actually used? We realized that material A used 3,000, material B used 8,200. So we have to get a difference. So the difference is going to be 3,484. And then the difference here, 8,200 minus 4716. And that's going to be 3484. Now, is this favorable or adverse? Based on our standard mixture, that is the way we are supposed to mix the values, or we are supposed to mix the material, we should have used this, but we use this. So you realize that we've used less than what the standard said we should have used. So this is going to be a favorable variance. And the same thing happened to the B, a favorable variance. For these variances, we take it at the standard cost per kilogram. And for material A is 2.5, material B is $3. So when we multiply up, the answer we get becomes the material mix variance. Victor, are you okay with material mix variance?
Yes, sir. Yeah,
Okay.
I'm clear with it. Yeah.
All right.
What about the yield?
Yes, so I'm coming there. So let's come to the yield variance. The yield variance has to do with the output we are supposed to derive or we are supposed to get from the actual unit that has been produced. So in a simple language, if you realize the total material we've used is 11,200. And for each unit, our standard said we should use 19 kilograms. So how do we get a yield variance? Very simple. I'm going to put that there. We will say that 11,200 kilograms should have yield. Then we'll divide that by the number of kilograms that will be used per unit. And that is 19 kilograms. So 11,200 divided by 19, what do we have? That's going to be 589 approximately, or we can say 590 to the nearest whole number. So 590 units. So this 11,200 kilograms of material should have produced 590 units. But how many units did we actually produce? In my example, it was 1,000 units. So you realize that but did yield 1,000 units. So you realize that we have had more than how much we were supposed to have had. So when we check out the difference, that's going to be 410. So this 410 is in units. So we will take it at the standard cost per unit. Standard cost per unit. So what is the standard cost per unit? This is the standard cost per unit. We add this up, 27.5 plus 24, and that's going to be 51.5. So we multiply this by $51.5 in relation to that. That is what you have to understand when we talk about the issue about the yield variance.
So in this case, the multiplication, the values, this time around you add the standard cost of material A and B. You don't do them separately.
Yeah. You add the two up because no, you see the yield variance can be done in total, but also can be done for each of the materials. But I have done it in total. So when you do it in total like that, then you have to add the total cost per unit. The reason why we are adding the two is that we are in units. So since you are in units, you have to deal with it with the standard cost per unit.
So in this case, in examination, which one is appropriate? Are you to do it in total or?
If you do this, you are correct because the answer will be the same.
Okay. Okay. Thank you very much.
All right. So that is it about your mix and yield variance.
Okay.
For those of you watching on YouTube, if you have any questions, you put it in the comment box. Now, Samuel Quasin said, could you please touch various finance aspects to strategic case study? Okay, so let me touch on that real quick. I believe no one is writing. Even if you are writing, okay, let me just give you some few minutes for those of you in case you are writing. Those of you watching on YouTube, give me a thumbs up on the video and make it more engaging so we'll be able to reach as much people as possible. But most importantly, comment below with all of your questions. I'm going to be answering all your questions for you to be able to help you. This is Q&A session, so make sure that you are active. Okay, so let's go. So I'm answering a question from Samuel Quasin, who said, could you please touch various finance aspects relating to strategic case study? So when it comes to strategic case study, the various finance aspects to strategic case study includes a lot of issues and entails a lot of things. So I titled that as financial perspective when it comes to strategic case study. Now, with financial perspective in strategic case study, we are looking at the four major decisions that the CFO, that is the Chief Finance Manager, enables the business or assists the business to make. These decisions include investment decisions, financing decisions, dividend decision, and then risk management decisions. So when it comes to strategic case study, these four core things summarizes everything we need to understand in relation to the finance perspective. Let me change. So when it comes to the investment decisions, for instance, okay, I think I'm back. I don't know, my network is just messing me up. Okay, so let's go. So when it comes to the investment decisions, what do we look out for? This answers the question, what investment opportunities do we put our money into? So when it comes to investment decisions, topics such as investment appraisal, it's critical. But the investment appraisal will look at the long-term investment that the company must make. But one of the issues also about investment decisions will be management of working capital. So working capital management. So how the company will manage inventory, trade receivables, trade payables, and all of that, it's something that we need to look out for in relation to that. Still about investment decisions, when companies are making investment decisions, one of the things they will look out for is the issue in relation to business valuation. But really, this is quite advanced when it comes to strategic case study. So the examiner may not take us there in relation to that. So on the investment decisions, we'll be looking at investment appraisal, which is key, and then working capital management, which is also key in that case. Now, at the end of the day, one of the things that are critical that the examiner will always bring something on under strategic case study will be about financing decisions. This is divided into two, and I like to put it this way: where do we get the money from? And what is the cost of the money? Where do we get the money from? And what is the cost of the money? Now, when we say where do we get the money from, we are talking about sources of finance. So short-term sources of finance, long-term sources of finance, and the various issues about it. And what is the cost of the money will be the cost of capital. Together, these things are called business finance. So that is the idea about financing decision. But remember that when we are looking at the financing decision, we follow the pecking order theory, which means we first go to our retained earnings, then we come to debt finance, then we come to equity finance. Now, one thing that is critical to a financing decision is the dividend decision. Now, because if a company pays out a huge amount of dividend, it means it will not be able to retain more money or more profit. If it is not able to retain more profit, meaning that definitely it will not be able to make as much as profit as possible that it was to make, or it will not be able to retain a lot of funding to be able to undertake investment projects. So the dividend decisions as to the dividend policy of the organization, whether they are paying zero dividend, whether they are paying constant dividend, or whether there is a constant growth in dividend policy, whatever policy the organization uses, it is tied closely into the financial decision or the finance decision of the organization in relation to that. Then the last aspect has to do with risk management decisions. So the risk management decision is divided into two, where an organization deals with international trade. Now, when we say an organization deals with international trade, either it is selling in a foreign currency or it is buying in a foreign currency. When a company sells or buys in a foreign currency, it is going to face foreign exchange risks. So currency risks or foreign currency risks is the first aspect of risk management that we have to look out for and consider when we are dealing with the issue about risk management. And there are various hedging methods that an organization can use What's going on with my network today? So there are various hedging methods that a company can use, like money market hedge, like forward contracts, like options, like invoicing in home country currency, like nets off. All these are strategies that a company can use to hedge itself against negative movement in foreign exchange. But another thing is that companies will borrow money every time to undertake investment projects because debt is sweet. Debt is that tax deductible. But you know, even though we say that in financial management, when advanced taxation comes in or taxation comes in, the tax authority will be using the thin capitalization concepts to decide how much of the interest will be allowable or will not be allowable. But for now, we will say all our interest will be tax deductible. So since the interest is tax deductible, maybe we want to undertake a project in the next 2 years. If we wait till 2 years to go and borrow the money, the interest rate may be different. So the second aspect of risk management is the interest rate risk management. So the fact that there could be a possible increase in the interest rate, let's find out how we can hedge it. And there are foreign exchange, how do we call it? Foreign forward contract arrangement we can have with a bank. There are foreign options that we can use in relation to this interest rate. So when it comes to the financial aspect for strategic case studies, these are the things that you have to look out for in relation to that. Then certainly to top it all up, the issue about budgeting is going to be very critical. So preparation of budget for an organization, it's also going to be critical in that case. Okay, so Samuel, that is the answer to your question. Now, for those of you on the Zoom call, if you have any questions, you click on the more button and you can raise your hand. You click on raise your hand button on the more, and I will call you to ask your questions. I see Grace Apanya Esiama. Hi, Nhyira. Hello, Grace. I believe you are doing well. If you have any questions, you put it in the comment box and I will be answering them for you in relation to that. Ruben Bologna on YouTube said, could you please explain the use of residual income and return on investment in divisional performance measurement? Okay. So when it comes to divisional performance measurement, there are a lot of indicators that we can use to measure a division's performance. One of those indicators is the issue in relation to residual income and then return on investment. So let me explain that for you, Gabriel. So residual income is more or less like free cash flow. In other words, how much money will be left for the company after we pay the providers of finance for how much they gave us for the job. So residual income is going to be your profit minus notional interest. So what does that mean? Let me pull a scenario out. So let's say that a division makes a profit of say $20,000, and the investment in that division is say $200,000, and finance providers requires a return on investment of, let's say, 35%. So how do we calculate the residual income? The residual income, RI, will be equal to your profit, 20,000, minus 35% of 200,000, 0.35 by 200,000. That's going to be 70,000. Now, in this case, you realize that the division will not be able to even pay for the, the division will not be able to pay the providers of finance from the profits they are making. So it means this division, for instance, is not doing well. But assuming we have a return of, say, 15%, can that be a bit lower? 0.15 by 200. That's 30,000. That's still high. Maybe let me just do like 8% so that I will get something below that. But like I said, assuming our returns is 70,000, our profit is 20,000, it means that residual income is actually negative of 50,000, which means the division is not making profit to even pay the providers of finance, which tells us that the division is actually not doing well as an organization. But if I use the 8%, 0.8, 0.08, 0.08 by 200, that's 16,000. So in that case, it will be a bit closer. And so that gives me 4,000. So this is the free cash flow. It means the money that will be left after providers of finance are paid their income. Then the next thing is return on investment. The return on investment is simply your profit divided by investment times 100. So if I'm using the same question, my profit is how much? 20,000. And then my investment is 200,000. So times 100%, I think that should give me 10%. So if I'm getting 10% on that, you realize that we will compare this figure against the company's required rate of return. Okay. Right. So our return on investment, profits of our investment, and then When we use the same question, it means that we're going to get 10%. This return on investment will be compared with the target required rate of return of the division of the company. Then we will decide whether the company is doing well or it's not doing well in relation to that. So Rubin Bologna, that is the difference between the residual income and then the return on investment in relation to that. Then still on YouTube, I see another question from okay, Samuel Question said, thanks so much. Now, Grace Akpanya said, please explain how to calculate capital allowance where there is residual value. Grace, I guess your question is in relation to investment appraisal. Is that what you are asking about? I think so. So Grace, maybe you can clarify if it is about investment appraisal. Okay, Ruben said it is clear. Thank you. You're welcome. So Grace is asking how we calculate capital allowance if there is residual income. I am assuming that that is an investment appraisal question. So if it is an investment appraisal question, how do we go about it? Now, when it comes to investment appraisal, one key computation is the capital allowance calculation. And many students actually struggle with this. So make sure you understand the concept and the principle very well. So how do we go about that? To help me to answer this question proper, I'm going to use a guinea pig question. So let's say the cost of the machine, it's let's just say 1,800. And let's say that the tax rate given to us is what, 25%. Let's say the capital allowance in the question is say 20%, reducing balance. And let's say the residual value, which is where Grace's question is, let's say it is $300. Now, how do we calculate the capital allowance? Now, let's say this project has a life of, not to make it long on ourselves, so let's say it has a life of 5 years. Now, be careful very well here. When it comes to dealing with the issue about capital allowance, you have to always look at the issue in relation to the figure, the statement made. Note that even though the examiner said capital allowance 20%, that does not mean that is the capital allowance. That is actually the depreciation figure. So what do we mean? So I put my schedule up. I'm going to put year here. I'll put cost here. I'll put the depreciation here. Then I'll put the capital allowance here. So follow me carefully. Now, the tax rate is what we use as the capital allowance. So that is going to be 25%. And then the capital allowance that the examiner gives us in the question, remember what I told you, that is the depreciation figure, 20%. Why? Because capital allowance is always calculated on the depreciation figure. So the examiner can lie to you and he will tell you capital allowance is 20% reducing balance. If you go and pick that, where Diego. So how do we go about that? So year one, we're going to have the cost, 1,008. So we take 20% of that. So 0.2 by 1,800, I think that should be 360. So on this 360, we take 25%. So 360 by 0.25, you can also calculate this, okay? And that's going to be 90. That's year one. Now remember we are told the depreciation is reducing balance. So for year two, we will subtract the 360 from the 1,008. So 1,800 minus 360, that's 1,440. Then we'll calculate the depreciation for year two. So that's going to be 0.2 times 1,440. That's 288. Then on that 288, we will calculate 0.25. And that's going to be 72. That's year two. Now remember, we are dealing with 5 years here. So year three, we count 1,440 minus 288. We get 1,152. Then we do 20% of that, 1,152 by 0.2. That is 230. On this 230, we take 25%. And that's going to be 58 to the nearest dollar. Then year four. Now remember the life of the project is 5. So we come to year four, 1,152 times 0.2. No. 1,152 minus 230. That's 922. So 922 by 20%. That's going to be 184. On this 184, someone is joining. On this 184, we will do 25%. And that's going to be 46. Now, please follow me here. Grace, this is where your question is. In the 5th year, this is where you've got to be careful about the whole thing. So in the 5th year, what is my carrying value of the asset? 922 minus 184. And that's going to be 738. Let me write what? 738. Now, in the 5th year, which is the final year of the project, the asset has a residual value or a scrap value of $300. A scrap value of $300. So how do we calculate the capital allowance for the last year? What we do is that we will subtract this residual value from the figure we had here. So 738 minus 300. And we'll be left with 438. Then on this 438, we will take 25% straight of it. And that becomes the capital allowance for the final year. And that's going to be 110. That is how we calculate the capital allowance when there is a residual value. Now, assuming the scrap value was more than this 738, then it means we will make a profit when we dispose of the asset. For that reason, we will be paying tax in relation to that. But as it stands now, when we sell the asset, we'll be making a loss. So since we are making a loss, we'll be claiming an additional capital allowance of 110. So this is how we calculate capital allowance when there is residual value. So Grace, this is the answer to your question. Indicate in the comment box, let me know if you understand that well. Okay, so for those of you who are on the Zoom call, if you have any question, click on the more button and you will see raised hand. Click on that and it will indicate that you raised your hand. Then I'll call you, then you will ask your questions in relation to that. I see Isaac, Nana, Rubin, Bologna. I think you've left YouTube to join us here on the Zoom call. So if you have any questions, you just raise your hand on the more button, and then I'll be able to call you in to ask your questions in that case. On YouTube, I see another question from Augustine. He said, many textbooks say that absorption costing is more superior to marginal costing. Why is it so? Now, it is not about superiority, but it's more or less about conformity with GAAP. Because according to IAS 2 inventories, inventory must be valued at full factory cost. Okay, so if inventory must be valued at full factory cost, using marginal costing will not give us the full factory cost, but using absorption costing will give us the full factory cost. That is why always it is preferred that we use the absorption costing rather than the marginal costing in relation to that. So it is because of its conformity with generally accepted accounting principles and also the accounting standards such as IAS 2, which is valuation of inventories in relation to that. So Augustine, that is the answer to your question. Rubin Glonia on Zoom, you've raised your hand. You can unmute your mic and then you can come in.
Yeah.
On YouTube, Grace said, yes, I'm okay. All right, that's fine. Yes.
Okay, thank you very much, sir. So I want to ask, I want to know the concept behind calculating the capital allowance on the depreciation, as you have indicated on the board. The rationale behind calculating the capital allowance on the depreciation.
And not on
the cost of the asset.
Okay, okay.
Probably.
Now, the concept is that when it comes to tax purposes, the tax authority is going to disallow depreciation because the tax authority doesn't know anything about depreciation. So the tax authority will disallow depreciation. However, if we are inputting tax on the, can you hear me?
Yes, I can hear you,
okay.
Sir.
If, however, if we are creating tax or scheduling tax for the investment appraiser, we cannot calculate that straight up on the cost of the asset. For that reason, we will charge the depreciation on the asset, then the percentage of that depreciation will be taken using the tax rate. Now, why is this important? Because the depreciation is the written down value of the asset that we are charging every year. So that written down value of the asset that we are charging every year, the tax authority will not allow all of them. The tax authority will only allow up to the tax rate payable. That is why we will calculate the capital allowance always on the depreciation figure and not on the cost of the asset. The opposite is that assuming we did not buy this asset outright and we lease the asset, we can as well claim capital allowance on the annual lease payment. So in that case, the annual lease payment, we can claim capital allowance using the tax rate on the annual lease payment in relation to that. So the reason or the rationale behind it is that the tax authority will not allow you to charge all your depreciation, but for tax purposes, it will allow you to the percentage of the tax payable in relation to your organization or your structure in relation to that. That is why it is not computed directly on the cost, but it is taken as a percentage of your depreciation that you have charged during the year.
Thank you very much, sir.
Okay. Techno Spark 2.
Hello.
Who is Techno Spark 2? I see your hand up. I don't know if I'm right. Is your hand up?
John Adu. I do John. John Adu.
Hello?
Hello? Yes, sir. Is that John Adu? John Adu?
Yeah, come in.
John Adu. Please, I want you to take me to transfer price using the marginal costing and then the absorption costing approach.
You said I should.
Transfer price using the marginal costing and the absorption costing approach. Transfer price.
Okay.
Yeah, using the marginal and then the absorption costing approach.
Okay, it's the same thing here. Now, if we are determining the transfer price and we are using the marginal costing approach or the absorption costing approach, is simply based on the concepts that the organization uses in the determination of the cost of the product. So under marginal costing school of thought, it means that the cost of production is determined Hello? A network, I don't know. Can you guys hear me well? Okay. Right, so in our costing school of thought, it means that the cost of production, what is going on with my network, is determined. Give me a moment, let me see if I can fix this network. You guys hear me well?
Yeah, it's okay now on YouTube.
The network is just messing me up today. Hello? The network, I don't know. Can you guys hear me well?
Yeah, but we can see the
Very difficult to hear, sir.
Right, so in our costing school of thought, it means that the cost of production is determined. Let me see if I can.
It's okay now on YouTube.
The network is just messing up.
Yeah, the network is very poor, sir.
I just don't know today what's going on with my network. Just messing me up. Can you guys hear me now? Hello? The network, I don't know.
Not bad.
I'm trying to even change from one network to another. Just indicating.
Yeah, our mics are on, so there's feedback all over.
Please turn off your mics. Okay. Hello? Still getting feedback. The network is unstable. Hello?
Yes, sir.
Are we quite okay now? I think
It's
I'll
better
try
now.
to change the network.
It's
Vodafone-
okay, sir.
Okay. Vodafone is misbehaving. MTN too is misbehaving. I just don't know network to trust. Okay, so let's go. Right. So when it comes to determination of the transfer price, in the marginal costing school of thought, it simply means that we will determine the cost of the product by looking at the marginal cost, which is the marginal cost or which is the variable cost of producing the product. But in the absorption costing school of thought, it means that we are going to be determining what? The full factory cost of producing the product. So if we're in the marginal costing school of thought, it means that we will determine our transfer price by determining the total cost of production, but the total cost of production will be based on only what? The variable cost. Then, if we are in the absorption costing school of thought, we will determine the transfer price by determining the cost of production. But this time around, we will be including both what? The variable cost and then the fixed cost or fixed overheads absorbed in relation to that. Now, once we determine the cost, either using absorption costing or using marginal costing, then we will be able to now decide whether we are going to be using the percentage profit on each of them to be able to calculate the transfer price in relation to that. So the simple distinction is that with marginal costing, the cost of production is determined by looking at the marginal cost of production, which is taking into consideration only the variable cost we incur in producing the product. But if we are using the absorption costing school of thought, that means we are going to be including both the fixed and then the variable cost in relation to that. Do you get a concept?
Yes, sir, please. Thank you, sir.
Okay. So if you have any questions, for those of you watching on YouTube, comment in the chat box. I'm reading all of your comments and I'll be answering. And give us a thumbs up on the video on YouTube so that we get more engagement about it, and share the video as well with others. And then for those of you who are on Zoom, you can click on the more button. You will see raised hand and you can raise your hand and indicate you have a question, and I will call you in to answer your questions for you. Okay, so we don't have any hand up yet. All right. Now, so any questions? Let me cross check. If Ike Wood, I see you just joined, and then Joseph Edu. If you have any questions, you comment below. Someone is just joining. Oh. Am I seeing some hands up? Let me see. Victor.
Hello, sir. Please, about the transfer pricing. Can you
Yeah.
go over about the transfer pricing for me, sir?
Okay. I could said video is not clear. It's just going to be because of my network, not rendering the videos a bit well. So I could, if the video is not clear, it's just my network. I don't know what's happening to my network today. The network is not rendering my videos well. Okay. So I was asked to look at the transfer price again in relation to that. So what's the question that TechnoSpark 2, I forgot, I don't know if you mentioned your name, maybe I didn't hear well. No, Edu John, I remember. Edu John, I remember. So Edu John said that, how do you determine the transfer price? Because you see, when it comes to divisionalization, companies like a car manufacturing company, so let me go over that real quick. Let's say we have a car manufacturing company, and then, okay, so Ruben said the video is clear at my end. So I could maybe check your network. It could be, that's why it's not clear at your end. So I think the network is not too good, partly because that could be the reason. Now, so let's say we are a car manufacturing company. A car manufacturing company does not have one division. It has various divisions. It has a division that deals with the body building, that is formation of the body. It has a division that deals with the windscreen. It has a division that looks at the engine. It has a division that looks at the seats. It has a division that looks at the interior in relation to that. And now with luxurious vehicles, the interior is even more important than even the outward look for the car in relation to that. Now, at the end of the day, each of these divisions will have to transfer the things that they produce to the assembly and finishing department. It is the assembly and finishing department that will put the pieces together for us to get a car. The question we then ask ourselves is, at what price should the windscreen division sell the windscreen to the assembly and finishing department? The price at which they sell the product from the division to another division within the organization is what is referred to as transfer pricing. It's also called internal charge. Now, remember that each division is given an amount of money. So at the end of the day, the division has to be profitable. But we have to be careful that one division is not profitable at the expense of another division. That is what is referred to as goal congruence. So to achieve goal congruence and to ensure that one division is not making much profit than another division, we have to set a price at which they can transfer the product. But before we come to maybe sensitivity or the sensibleness of the price they will set to the other division, they can decide to use either the marginal cost or to transfer it at the full factory cost, which is the absorption costing. So like I said, if they are using marginal cost, it means if they determine their cost of production, they will include absorption of overheads. They will include fixed cost because they know that the fixed cost will be incurred whether they transfer to them or they sell it to the outside in relation to that. So if they are using the marginal cost, they will look at only the variable cost of producing the product. And once they are looking at the variable cost of producing the product, that is what they are going to use. And once they get the cost, maybe say $2,000, they may put a markup of 20% on that. And that would be maybe $2,400. And they will be transferring each windscreen to the assembly and finishing department at $2,400. They could also determine the total cost by looking at the absorption costing, which is the full factory cost. Okay, which is the full factory cost. So if they are looking at the full factory cost, then in that case, what is going to be happening is that they will include both the fixed cost and the variable cost. So once they are looking at both the fixed cost and the variable cost, then at the end of the day, they will add their markup, and that will determine the price that they will use to transfer the goods to the assembly and finishing department. So that is the answer. I think, who asked the question? I think Victor, right? That is the answer. Does it make sense now? Are you okay?
Yeah, I'm okay, sir.
All right. So I see some comments on YouTube. So let me go on YouTube and then bring some questions up. Now, for those of you on the Zoom call, like I said, if you have any questions, you know what to do. Look at the more button, you raise your hand, and I'll get the indication here, and I'll be able to call you in so you can ask your questions. Edu, is your hand up?
No, that was the earlier one.
Okay. I think it's the earlier one. Okay, so let's go. Augustine A. Boatin on YouTube said, is that why it says absorption costing is good for external reporting purposes? Yes, that is why we say that. That's why we say that. Prince Ano on YouTube says, so please, do you have to prepare a cost card? I don't know the context in which you are asking the question. Prince, can you clarify? I think you are doing introduction to man accounting and you're asking whether, I don't know if you're asking whether in the exam or you'll be asked to prepare a cost card. But if that is what you are asking, the answer is yes. The examiner can ask you to prepare a cost card. So I see some people coming in. Let me add them real quick. Okay. Any other questions for me real quick? So you indicate by raising your hand and I will be answering all of your questions for you. Okay, so I see some people joining, like Huawei Y919. I don't know who is that. So if you have any questions, you can indicate, raise your hand, and then you can ask your question, mention your name and ask your question. Then I see Divine Courage also joining as well. Then I see Chino, you are also joining as well. So if you have questions, click on the more button below your screen and you can ask your question. Okay.
You can, as we go to lecture, the day in house.
No, that's sometimes.
But yeah, this one, the lecture.
Please turn off your mic if you're not talking so that we avoid feedbacks coming in. Okay. Bernard Mensah, I see Bernard Mensah also joining. I don't know. Okay. All right. So YouTube, if you have questions, put it in the chat box. Give us a thumbs up as well on the video on YouTube so that we get a video engaging. And then for those of you who are on the chat with me here on Zoom, you just click the more button. You will see raise your hand and you will be able to raise your hand and I'll get the indication and I'll bring you up with it. Okay, so I see some people raising their hand. Let me just see. Hayford, Marfo, you can unmute your mic and talk.
Hello.
Yeah, Hayford.
Please, I actually joined the video class.
Is that?
I joined in late, so I
Okay.
just came in about a minute ago. So I wanted to ask what time you start.
You said you wanted to ask?
What time actually do you start?
Oh, we started around 4:30.
4:30. Okay,
Yes.
all right.
So it's a Q&A session. So if you have any questions on man accounting, strategic case study, that's what we are focusing on really today. So if you have any questions on those things, then you can ask a question about it. But we started at 4:30, so barely like 2 hours ago. Wow. That's
Is
good.
it something that's going to go on continuously every day?
Technically, the actual thing is we are putting this week up. So yeah, we started yesterday. Yesterday we did financial reporting and corporate reporting. So the whole of this week, I'm doing this open and executive Q&A session on Zoom, and it will be streaming as well on YouTube. So for this week especially, we are just putting it down for this Q&A session. But as time goes on, certainly we'll be adding more sessions. But this whole week, this is what we are looking at.
Okay, that means as soon as it's 4 p.m., I can catch you live, right?
Yes, you can catch me live. It's actually 4:30, so you can be on standby by 4 p.m. and by 4:30 we are live.
Okay, thank you very much.
It's a pleasure.
And God bless you for your good works.
God bless you too. So on YouTube, I see a question coming from Prince Anna. He said, "Sir, please, can you teach us something about piece rate system?" Okay, so let me talk about piece rate system real quick for Prince. Festus Bruce, I see you joining. If you have any questions, you raise your hand. I'll get an indication, then I'll add you. I see other people's raising their hand. Ruben Bologna, I see you raise your hand. Give me a moment. Let me finish with Prince's question and you will come in.
Okay, sir. Okay.
So Prince said, can I teach something on the piece rate system? Now, when it comes to accounting for labor, one of the things we're going to be looking at is methods of labor remuneration. And we have the time rate system and then the piece rate system. The piece rate system is simply we are determining the labor cost by looking at the outputs produced by the labor. So we say that the wage equals units produced times the rate per unit. So that is the formula for getting the value or the wage rate when it comes to the issue in relation to wage under the piece rate system. So if, for instance, this mic is on, I'm getting some feedback here. Please turn off your mics if you're not talking to avoid any feedback coming in. So units produced, let's say for instance, during a year, let's say this. Let's say an employee produces 200 units and the rate, the unit, it's say $10, then the wage is going to be 200 times 10. And that's going to be what? $2,000. But there are some times when we will have what is called the group piece rate system, where to be able to motivate the employees, we will have a certain output scales. So for instance, this is what we have. This is what I mean. For instance, we will say output 0 to 100, we will pay a rate of $20. Output 101 to 500, we will pay a rate of $50. Output 501 to say 1,000, we will pay a rate of $100. So if we want to determine the wage for an individual, we will ask, how many units did the individual produce? So if the individual produce, let's say 340 units, we will ask ourselves, where does 340 units cover? Oh, sorry, is. Now, if you check, you realize that 340 will be between 101 and 500. So we will use the rate of 50 to determine the wage. So our wage will be equal to the 340 times $50. And the answer we get, let me just punch that, 340 by 50, and that's going to be $17,000. So that is the concept about that in relation to that. So Prince Ano on YouTube, you said I should talk about something in relation to the piece rate system. There you go in relation to that. Then I told somebody to hold on. I think he's no more. Ruben Blonya, I think he's gone. So if you have any questions, for those of you who are on the Zoom call with me, you can indicate, click on the more button, and I'll be able to get the indication, and I will call you to ask your questions. Okay, so Prince Ano on YouTube said, thank you, sir. You are welcome. Ruben Blonya on YouTube. Okay, you've gone back to YouTube. Eh? He said, sir, please, which course are you treating tomorrow? The details will be communicated on my Facebook page. So Ruben, you can check the details on my Facebook page tomorrow morning. Nhyira Premium, we will share it on the Facebook page or WhatsApp on various platforms. So you'll be able to know about that. Okay, so I see a chat on our Zoom chat from Ike. Ike Wood said, want to know how activity-based costing is calculated. If you say you want to know, Ike, can you clarify the question? Because activity-based costing, it's a module used to determine the cost of a product. So are you saying I should explain activity-based costing? Or what exactly do you want? So please give me a clarification on the Zoom chat, just like where you asked the question, then I can answer. Yeah, Victor, you can come in and ask your question.
Sir, my question is about flexible budget.
Okay.
You see, the flexible budget, sometimes they can give you in percentage, other times too, they can give you in raw figures. Sometimes in the percentage form, it's very difficult for me to understand how to flex when the percentages are given.
Okay, so you want me to throw some light on that?
Yes, I want a gist on the when it comes to percentage. When you want to flex it with the percentage, I want to have an idea about how to flex when giving the percentage.
Okay, now I think a better way to answer this one is to solve a question actually with you guys, because you are not the only person who has asked this question. I think I've received it in my DM for some times now, since last week. So this is what I'm going to do, Victor. I'm going to be solving a question on that, really, because when it comes to the percentages, yes, we're going to be expressing everything in the percentages, taking the standards and then taking the actual in relation to that. But I will have to use a full question, which I would have to look for. It's not, I can't just nail it up here. So this is what I would do. Tomorrow I will not do MA, but maybe before this week ends, I'm going to pick a question to solve on the flex budget percentage-wise so that we can deal with that issue. Okay, Victor? So I will do that in the course of the week for you to solve a question actually.
Okay, sir.
All right. Now, on our Zoom chat, Ike said, yes, please. I want an explanation on activity-based costing. All right, so let's go there. Now, activity-based costing is one of the interesting aspects, and the reason why it was developed was because the absorption costing was not able to really enable entities to apportion their overheads very well. So what happens? In the activity-based costing, we follow a certain process when it comes to using it in determining the cost of a product or a service. The first thing is to identify what is called the cost pool. The cost pool represents the major cost item that the entity is going to be incurring during a year. So the cost pool can be maybe ordering cost. The cost pool can be production cost. A cost pool can be maintenance cost. A cost pool can be dispatch cost. So the first thing we do under activity-based costing all the time is to identify the cost pool. That is the major cost items, that is overhead cost items in the organization. Once we determine the cost pool, we come to the second thing and determine what is called the cost drivers. The cost drivers are the major activities that causes the cost. In other words, if we are determining ordering cost, what activities causes ordering cost? So we realize that the cost driver for ordering cost will be the number of what? Orders. If we are looking at production cost, the cost driver will be something like number of machines set up. If we are looking at maintenance cost, we may look at something like either machine hours or still number of machine setup. Then if we are looking at the dispatch, cost driver will be the number of dispatch we made during the year. So first thing, you determine the cost pool. Second thing, you determine your cost driver. Third thing is to calculate your overhead cost per cost pool, right? I like to put it this way, the overhead absorption rate per the cost pool. What does that mean? So at the end of the day, the examiner will give us the overhead for each of these guys. So when we say the ordering, maybe that is $100,000, and then we'll add the total number of orders for the products we have. Maybe let's say it is 200. So we will calculate the overhead absorption rate per order. Overhead absorption rate per order. So that is going to be the ordering cost, which is the cost pool, divided by the cost driver, which is going to be what? The number of orders. So that gives us the overhead absorption rate per the cost driver. Once we do that, we will now go to the fourth step, and that is to you allocate the overheads to the products using the overhead absorption rate. So now we have calculated or compute the overhead absorption rate. Then for each of the products, let's say we are having two products, product A, product B. Product A did 10 orders. So we will multiply the overhead absorption rate by what? 10. And that will give us the ordering cost for product A in relation to that. Then once we allocate the overheads, when we finish, we add all of them up to determine the total overheads. And that is how we use the absorption costing. So once we have the total overheads, if we are doing the cost per unit, we will divide the total overheads by the total units. Then we'll get the overhead per unit. And once we have the overheads per unit, we go back to our cost card or our cost sheet, and we have direct material there already, direct labor cost there already. We add them up, that gives us the prime cost. Then we'll add the overheads that we got from our computation here, and that will give us the total cost. So I could, this is the concept about absorption, sorry, activity-based costing. Do you understand? Okay, I could said, okay, sir, thank you. I see someone raising the hand, Galaxy A20S. Please mention your name, unmute your mic, mention your name and ask your question.
Please, please, good evening. And yes,
Yeah,
please,
good evening.
And then, please, I wanted you to explain
said your
certain
name
things
is?
on the time series. Prince Arno.
Okay, okay.
Yeah, and then I wanted you to teach us something about time series.
Time series. What
Yes,
exactly
please.
do you want me to talk about there?
Please, about how to use the Lillian regression line.
The linear regression line. Ooh.
Line.
That is a whole show there. Those formulas, I don't have them offered, and I don't have my slide on that, Prince. So this is what I will do. Maybe tomorrow or in the course of the week, I could touch on that with Victor's question on flex budget, okay? Because I don't have those formulas and things here, and I'll pick an illustration question that will help us to calculate the trend or the linear regression line and also be able to explain it for you. So I'm going to add it to the other topics that I'm going to be teaching in relation to that. Please, who is Porsche iPhone on Zoom? Turn off your mic for me.
Okay.
Okay, thank you very much, baby little girl. So let me add this up. So give me a moment. Let me just put these topics down so that I can touch on them. Because if I don't have something at hand now, I don't want to mess you guys up and give you anything bomb. So time series, regression line. Let me note this down. So I pick a question and explain it to you better. And then flexible budget percentages. Okay, so we go. For those of you who just joined, if you have any question, please raise your hand. Click on the more button. You can raise your hand, then I'll call you in to ask your questions. So Portia, if you have any question, you can raise your hand and I'll call you for you to ask your questions. We are focusing on man accounting and then strategic case study today. I'm going back to YouTube. Augustine said, let me open my app so that, okay, Galaxy A20. Prince, are you still, is your hand still up? Or
Yes, please.
okay.
Please, I wanted to ask for the level 1 man accounting,
yeah.
can they ask question and process costing? Can they ask us to prepare the work in progress? To prepare work in progress, opening work in progress.
I would have to cross-check that real quick. Give me a moment. Let me cross-check that from your syllable slide. Oh, let's see. Intro to my accounting. Let's just see that here. That's paper 1.4. Okay. Select an appropriate method for costing and calculate sales price for a given product or service, job costing, service costing, and process costing. Okay, we don't have really the scope, but I will have to confirm and get back to you on this, Prince. But in the syllables, the syllables just stated process costing. So it could be inferred that everything in process costing will be examinable. All right. But as to whether
Okay,
the
sir.
work in progress
sir.
thing will be included or not, I could check that later on from our teaching guide, which ICA gives to us, and I can tell you about the scope on that.
Okay, sir.
All right.
And please, thank you.
Okay, you're welcome. Now, going back to YouTube, Augustine A said, would the book value of material in store be considered irrelevant in relation to relevant costing? Now, Augustine, when it comes to relevant costing, you got to be careful about the book value. If the inventory is already in store, but the inventory is not in constant use, and also does not have any alternative use, then in that case, the relevant cost of the inventory is 0. So we have it in stock, it is not in constant use, there is no alternative use, then the relevant cost will be nil. But if it is already in stock and it is in constant use, then the relevant cost will be the replacement cost. So usually the cost at which the inventory was bought is a sunk cost. We don't consider it. So we will only consider the inventory being relevant if it is in stock and it is in a constant use. Then in that case, we have to replace it. So the replacement cost becomes the relevant cost. Other times, the inventory may be in stock. It is not in constant use. It does not have an alternative use, but a company can sell it out. So in that case, if we use the material for this job, it means we can't sell it out. So since we cannot sell it out, in that case, the relevant cost becomes the lost revenue, the lost sales, which is the opportunity cost. So that is what you have to understand when it comes to dealing with relevant cost of material and the relevant costing. So Augustine A, that is the answer to your question in relation to that. Okay. Any questions for me? You can indicate by raising your hand, then I'll call you up to unmute your mic. Then you can ask your questions. For those on YouTube, give us a thumbs up on the video and then comment in the chat box with all of your questions in relation to that. We are focusing today on management accounting and then strategic case study. And I love the questions coming in. Questions are just coming in from various aspects of the syllabus, and that's great because it's good for you in relation to that. Okay.
Hello, sir.
All right.
Hello.
Now, if we don't have any more questions, then please turn off your mic, turn off your mic, turn off your mics, turn off your mics if you're not talking. Please turn off your mic, turn off your mics, turn off your mics if you're talking. Don't worry, I've done that for you guys. So,
Hello.
So when it comes to the issue in relation to, okay, I see some people raising their hand. Techno, Edu, John, you can come in.
Okay. Please, can you give us, can you take me through the operating statement on the marginal costing, the operating statement, and the variance. Here's the format.
Okay. Operating statement and variance.
Yes, the standard marginal costing approach.
Okay. Yes, we could look at that.
Okay.
So turn off your mic, please, for me, so we can. Let me just look at my pro forma here. I have a pro forma here. Let me just look at the pro forma, then I'll use the pro forma to illustrate to you real quick. Now, the operating statement is prepared in variance analysis to reconcile and bring all the variance we've computed into a single statement. And there are two schools of thoughts or methods that we can use in the preparation of the operation statement or operating statement: the absorption costing method and then the marginal costing method. In the marginal costing school of thought, the pro forma is this. So I'm going to give you the pro forma, then I'll explain it to you in relation to that. So we're going to have 3 cash columns above here. They will bring our budgeted profit. Be careful here. When we say budgeted profit here, it means your units multiplied by the standard profit in relation to that. So when you bring your budgeted profit, you bring the budgeted fixed cost. Then once you bring your budgeted profit and you have your fixed cost, less out that gives us our budgeted contribution. Because if you remember, if I flip this approach up, you realize that when I have contribution and I less fixed cost, I'm going to get my net profit in relation to that. So if I have my profit up, which is based on the cost that we have had, the standard cost that we have had, and then we bring our fixed cost, then we'll get our contribution in relation to that. So once we have our contribution, 2 key variances that are going to be popping up that we have to look out for is the sales variance. And you remember that sales variance is divided into 2. We have the volume and we have the price variance. Then we'll get a figure there in relation to that. And this one is called the actual sales minus the standard cost. Now the question we ask ourselves is, okay, what is the difference between the marginal costing and the absorption costing? In the absorption costing, we wouldn't have brought the issue in relation to fixed production cost. All we will bring is to bring our budgeted profits. Then we will just bring our sales variances, and then we'll get the actual sales minus standard cost. So from here, we bring all our variances that has been computed. So favorable will be here, adverse will be here. So all of the variances we've calculated, we'll be bringing there in relation to that. And when we are in the marginal costing school of thought, remember, only the variable variances that you've calculated that will come, like material price variance, material usage variance, labor rate variance, labor efficiency variance, ideal time variance, variable overhead variance, and variable overhead efficiency variance. So variable overhead expenditure variance, variable overhead efficiency variance. So only those variances that will pop up here in the marginal costing school of thought in relation to that. Why? Because you have factored in your fixed cost above here in that case. Paul, do you get a clarity?
Yes, sir, please. I'm okay.
Do you get a clarity?
I'm okay. I'm gotten it.
I hardly hear.
I'm okay with it. Thank you.
All right, you're welcome. So let's see. I saw another hand up. Galaxy A20, that is Prince Arno, I guess. Your hand is up. Hello? Prince Arno, is your hand up? Okay, maybe. All right. Okay, so YouTube, I see a question from Charlotte Govina. Please, I think you should treat case study question and answers on a different day from performance measurement, because performance measurement will supersede the case study. Okay, Charlotte, I think that is something I will consider. Maybe from the way questions are coming up, we actually plan to do Monday to Friday, but maybe we'll have to do throughout the week up to Sunday, and maybe even extend it to next week. So I think this will be considered, Charlotte. I will add it to the issues I have here. So let's see, strategic case study question. Yeah, Victor, you can come up.
Sir, the contemporary evaluation, one is throughput, and if you can explain further small about the computation of the throughput accounting ratios.
So you want me to explain computation of throughput?
Yes, please.
All right, let's look at it. So Charlotte on YouTube, your comment, it's really considered. Definitely I'll have to do case study differently, because I realize that all the questions coming today, they are on MA. It's like the management accounting people, they've decided that they won't allow the case study people to talk. But let's go. So when it comes to throughput accounting ratio, we say that it comes from a school of thought that states that an organization has limited resources. And so the first thing that happens, now remember, throughput is closely related to limiting factor analysis. So when an organization wants to remove the bottleneck process or the limiting factor process, one of the ways to do that is to be able to calculate the throughput accounting ratio. So how do we deal with a throughput accounting? The first thing always is to determine the bottleneck process. What is the limiting factor for the organization? That is the first procedure. Once we determine what the bottleneck process is, maybe it is hours, or maybe it is material, or whatever it is, once we determine the bottleneck process, the next thing we do is to come to the throughput accounting ratio, which is returns per factory hour divided by cost per factory hour. Now you got to be careful when it comes to the throughput accounting, because throughput accounting is quite different from the issue in relation to marginal costing. Now, in marginal costing, we are interested in contribution. So in the marginal costing, we say that selling price minus variable cost. Remember, variable cost here entails the issue in relation to direct material, direct labor, direct expenses, variable production overheads. All of that will be included in the determination of contribution under marginal costing. But when it comes to throughput, the concept of throughput is that we say throughput equals selling price minus direct material cost. So when it comes to throughput, the assumption is that the only cost that is variable is direct material cost, and all other costs are referred to as factory cost. So the issue about direct labor, direct expenses, factory overheads, all of that will be put together into what is called factory cost. Why did I take you there? So the numerator, we're going to do a workings for it, and the denominator, we will do another workings for it. So workings 1, which is the returns per factory hour, it's equal to your throughput divided by the factory hour. Now, throughput, like I told you here, is selling price minus direct material cost. But this is what I want you to understand. The factory hour you are bringing here is the factory hour of the limiting factor. So if it is factory hours that was limiting factor, the process that was limited, that is what you are going to be bringing here. And that's how you calculate the numerator, returns per factory hour. Then you come to the denominator, and that is to calculate the cost per factory hour. So that is going to be your total factory cost divided by your total factory hours. So like I told you, your total factory cost will be direct labor cost plus factory overheads. All those will be factory costs. Then we divide that by the total factory hours available, and that gives us the cost per factory hour. Once we have the numerator and we have the denominator, now we can calculate the throughput accounting ratio. But when we calculate the throughput accounting ratio, it has to be interpreted. So there are 3 things we must understand. When the throughput accounting ratio is greater than 1, it means the product is profitable, so we should continue producing it. If we calculate the throughput accounting ratio and it's equal to 1, it means that we need to undertake a further investigation to really understand whether the product is a profitable product or not a profitable product. When we calculate the throughput accounting ratio and it is less than 1, it means it's a loss making. But when the product is a loss making, you don't say they should shut it down. You don't say they should stop producing it. So the question the examiner can ask you is, how do we improve upon the throughput of an organization or the throughput of a product? The way we improve upon the throughput is simply to adjust the elements you used to compute it. So number one way to improve the throughput is to increase the selling price. But remember, increment or increasing the selling price will be dependent on the market that the organization is in. So if the organization is in a competitive, perfect competitive market, that means if you increase your prices, people will go away. And we also have to look at the elasticity of demand of the product to be able to make that decision in relation to that. Then we can also reduce the direct material cost by finding alternative way to buy our raw materials to reduce the cost, if it means switching suppliers. But remember, reducing cost does not mean you are substituting shoddy goods for quality products, or you are foregoing quality because of the price. So you got to be careful also about that. Then you can also negotiate with the labor force to reduce the labor cost a little bit, because if we reduce the labor cost, the factory cost will be reduced and we can improve upon the throughput of the product. And then the final thing is that the factory overheads. We can check for that particular product, maybe there are certain general factory overheads. We can decide not to apportion them again to that product, or maybe we are incurring more in the factory overheads and we can decide to look at it well and then reduce it so that we can improve upon the throughput of the organization. So basically, when it comes to throughput accounting ratio, this is what you have to understand about that. Are we good?
Very well. I've gotten it right, sir.
Okay. Okay.
Thank
That's
you.
great. Oh, you're welcome. Any questions for me? Portia, do you have any questions for me? Portia, I see you have unmute your mic. You can talk. Is she talking? I can't hear you. Maybe I don't know if you are talking, but we can't hear you. You unmute your mic though, but we can't hear you.
Oh, okay. I said I'm okay.
Okay.
No questions.
All right. All right.
Okay. Thank you very much.
Okay, you're welcome. Now, so on YouTube, I see some questions there. Let me answer some of the questions from YouTube. Then we'll come back to Zoom for your questions here. So on YouTube, Augustine A said, please, how does an organization budget relates to its policy of, it's not complete. So I don't know. Augustine, you can complete your question, then I'll answer it better for you. Really said, why is it goodwill? Why is it that goodwill is not considered a depreciable asset? I guess you are asking this question in terms of, all right. Now, goodwill in terms of tax, I don't know, or IAS 38, intangible asset. Goodwill is not a depreciable asset because you can't depreciate goodwill. It's not a tangible asset. It's not an asset that you are using that you will say it will suffer wear and tear. It's an intangible benefit, or it's an intangible value. So for instance, you are buying a company and the net asset of the company is 100,000, but they said pay 110,000. So when you pay the 110,000, the extra amount you are paying, which is the 10,000, is the goodwill. And that's an intangible asset. So you cannot depreciate it because it is not an asset that can wear or tear in relation to that. Give me a moment, let me see if we can connect this device because it's almost going low battery. Okay. Then another comment still on YouTube from Pawili said, if I change the new business ownership name to my name, yes, Pawili, you can conclude your question on YouTube and I can further understand. You said, if I change the new business ownership name to my name, what do you want there? As the A20, is your hand up?
Yes, please. Yes, please.
A20.
Please, it's Prince Ano.
Okay, Prince.
Okay, sir, please, under time series, let's say for the November exams you wrote, under question 5, marginal costing. The question said you are required to prepare moving average. Here by the case, it did not say additive or multiplication. So the time I was doing the question, I used the multiplication. But in the time I want to check for the solution for the exams, the examiner use additives. So I want to ask, so in case the examiner don't ask for, let's say multiplication, do you have to use the additive all the time or what?
Yeah, because the traditional basis for time series is the additive model. The traditional basis for that, it is like dealing with cost sheet and dealing with standard costing and variance analysis. We assume that overheads are absorbed using labor hours. So when you are dealing with absorption costing, traditionally it is assumed that overheads are absorbed using labor hours. So in time series, if the examiner is quiet like that, then you go with the additive model in relation to that.
Oh, okay, sir. Okay, sir. So please, for do they have a difference between standard costing and then they have the difference between standard costing and then variance? Is there any difference?
Okay. Standard costing is the establishment. Standard costing actually have 4 stages. Is the establishment of cost, recording of actual cost, comparing the actual cost against the standard, and also investigating any variance. Now, variance analysis is picking the standard and then looking at why the actual is different from the standard. So standard costing and variance analysis is a build up from standard costing. So standard costing helps us to set the standard, record the actual, get the difference. So the investigation of that difference and why that difference comes in is where variance analysis comes in relation to that. But before we can distinguish whether this is the variance in relation to that. So before we can distinguish whether this is a favorable variance and adverse variance, we must compute it. So once we do the computation, then we now ask, why did it happen? When we are asking why it happened, then we are undertaking variance analysis in relation to that. So variance is a build-up from standard costing. Hello? Okay.
Please, you see, standard, you see, during SHS, we used to use the form to, let's say, determine our adverse and then
Hold on a moment. Yeah, hello, Prince. Go ahead. Yeah, Prince, go ahead.
Sir, please, I was trying to say that you see, under during SHS, and when they ask of standard costing, when you're dealing with that, when they ask of, let's say, material price variance, you'll be using, let's say, selling price minus actual price into bracket of that formulas. But it seems here we don't use that formula, so that's confused me a lot. So like I want to know maybe if here we don't use the formulas.
The formula is still used. The formula is still used. Only that, like if you watch my video on standard costing and variance analysis, I don't use the formula because if you chew the formula and you don't understand the formula, or you go to the exam hall and you forget the formula, you'll be in trouble. So I like to use a concept approach, but that formula is the same thing we are using here. The same SHS formula is the same thing we are using here, where you look at standard price minus actual price times the actual quantity. It's the same thing we are using here. Only that, like I said,
Okay, sir.
some people, like if you watch my video on standard costing, I don't do formula. I do the concept aspect of it because in management accounting, if you become a management accountant, you don't go to board meeting and you'll be quoting formulas. They don't understand formula. You must explain why you are doing what you are doing. That is why we will go with a concept approach, more preferable than the formula here. So it's the same thing that you are doing here. There's no difference.
Okay, sir. Okay, sir.
All right. Okay, so let's see things, get some clarity on my YouTube channel. Let's see what's happening on YouTube. Augustine Boatin said, I was asking how does the budget of a company relates to its policies? Yes, the budget of a company relates to its policies because if you watch my video on budgeting and budgetary control, I gave you a general procedure in the preparation of budget. Now, the general procedure for the preparation of budget is that, number one, the budget committee meets, okay? The budget committee meets. Now, when the budget committee meets, what do? Number one, they will determine the policies or the objectives of the organization, the goals, what the company wants to do for the period under consideration or into the year of the budget. So that is the first thing. So the budget is prepared based on the policies of the organization, the goals of the organization, the strategic objective of the organization. So the budget is closely related on the policies of the organization because that's the first thing they do. Before they will determine the basic assumptions they will be using in the preparation of the budget, and then any other issues that will be considered. So Augustine A, how does the budget relate to the policies of the organization? The budget is prepared based on the policies of the organization. So it is on the policy, what the company wants to do, what it wants to achieve. It is based on that the budget is prepared. So literally, the budget is drawn from the policy. The budget is drawn from the policy. So if the company has a standard cost of say every 2 kilograms, we will pay $5 per kilogram. This price of $5 per kilogram is based on the policy of the organization that we want to buy raw materials at $5 per kilogram and make it happen and do whatever you can do in order to make it happen in relation to that. So Augustine A. Boatin, that is the answer to your question. Then Pawili said, in relation to goodwill, if I change the new ownership name to my name, now that is internally generated goodwill. And according to IAS 38, you are not supposed to recognize internally generated goodwill. It is prohibited by IAS 38 for an entity to recognize internally generated goodwill. So probably, if you are asking it in relation to change of name, that is internally generated goodwill, and it is prohibited by IAS 38 to recognize that by an organization. Okay. So I think we're gonna be concluding somewhere around here for today's discussion. So if you have any other questions, you can raise your hand and then I'll bring you in for you to ask. I think it's been a fruitful day. We've had a lot of discussions. We've talked about almost everything: throughput accounting ratio, investment appraisal, relevant costing analysis, standard costing, variance analysis, and we've spoken about everything else in relation to that. Okay, so Pa Willie on YouTube said, thank you, you are welcome. So if there are no, okay, Prince Ano, you can come in. Prince Ano.
Sir, please, now, and yes, sir.
Yes, I'm listening.
Sir, please, and break even, and break even.
Yeah.
Sir, please, can you give us some clarities on break even analysis?
I hope you are not telling me to teach break-even analysis.
Oh no, sir, please, something let's do some summary of break-even analysis.
Okay, so let's look at that. Now, so when it comes to break-even analysis, we're looking at a couple of issues. There are various reasons for determining or using break-even analysis, because at the end of the day, the company would want to find out what outputs do I produce in order to break even. That is where my cost will be equal to my revenue. Or what outputs do I produce in order to achieve a certain amount of profit, and that is the unit for targeted profit. Or at what point can I start making profit, and that is the issue in relation to the margin of safety. So from all of these ideas and using all of these school of thoughts, there are a couple of things that comes to being in relation to that. So let's go through the idea about break-even. Now, there are assumptions about break-even analysis. Certainly, I know you know that already, so I'm not going to be going through that, which says all costs are divided into fixed cost and variable cost. The only factor affecting production cost is the output level. Selling price remains the same throughout the period. Variable cost per unit also remains the same throughout the period. These are some assumptions that we spoke about or that you have to know about. And if the examiner asks you limitations of break-even analysis, you just flip the assumptions up, because the assumptions are not true, because that's why we call it assumptions. They are not true. It means we are saying all other things being equal, but only the assumption. So if the examiner asks you limitations on break-even analysis, just remember the assumptions and then flip the assumptions up, and you'll be able to get your limitations. So after we get the assumptions, the next thing we look at is the various computations that we can have. And we can do first the issue about contribution, which you know already, the selling price minus variable cost. Then the company want to ask, okay, at what output level will our total cost be equal to our total revenue? So that is the break-even point, and that is in units. And that is going to be your fixed cost divided by your contribution per unit. Then another question the company would want to ask is, okay, at that unit where our fixed cost is equal to variable cost, sorry, where our total cost is equal to total revenue, how much revenue are we going to make? And that is the break-even point in value. So when we are dealing with a break-even point in value, it's going to be your fixed cost over contribution per unit times the selling price. Fixed cost over contribution per unit times the selling price. But there is another way that the break-even point in value can be calculated, and that is using the CS ratio. That is the contribution to sales ratio. So the contribution to sales ratio is your total contribution divided by total sales times 100. Now, it can also be contribution per unit divided by selling price per unit. It will still give you the same answer. So if we are coming from contribution per unit, then the break-even if we are coming from contribution to sales ratio, then the break-even point in value will be equal to your fixed cost divided by the CS ratio. And that will give you the break-even point in value in relation to that. Now, note that these can also be expressed on a chart, or if you want, on a diagram. So if we are expressing it on a diagram, we will have a diagram like this, and we'll have the output level here, and we'll have the currency here, which is in Ghana cedis or dollars, and we'll have the fixed cost coming here like this, FC, and we'll have the total revenue coming here, TR, and we have the variable or total cost coming here, TC. Now the difference between total cost and the fixed cost will be the variable cost. The point at which the total revenue meets the total cost curve is the break-even point. When we trace it to the output column, that will be the break-even point in units. And when we trace it to the currency column, that will be the break-even point in value. Now, this place is a loss making. So as far as we are producing from 0 to the break-even point, we are making losses. If we start after the break-even point, it means that is the point at which we are going to be making profit. So basically, if you want me to talk about something about break-even, this is what I would say about that. Now, we can calculate units for the targeted profit, and that is going to be fixed cost plus target profit over contribution per unit. That is measuring the output level we must produce in order to get a certain profit. So maybe our objective is that during the year, we want to make a profit of, say, $10,000. How many units must we produce and how many units must we sell in order to achieve that profit? That is sales for targeted profit, and that could also be asked, and that is the approach in relation to that. Then there is the issue about margin of safety, which is the difference between the budgeted output minus the break-even point. So for instance, if our break-even point is 10,000 units here, and the company has budgeted to produce 20,000 units, or let's say 17,000 units. So the difference between the 17,000 and then the 10,000 is the MOS in units, and that is the margin of safety in relation to that. So Prince, if you want me to talk about break-even, this is it. Is there anything that's aside this, or that's okay?
Oh, sir, please, I am done. It's okay.
Okay. So I see a chat on our Zoom here. Victor said, please say, when will FM come on? We will communicate all that on my Facebook page. So in case you've not liked my Facebook page, as well as on my YouTube channel, in case you've not subscribed to my YouTube channel, you can follow me or like my Facebook page, and all that will be communicated. But like I said, the whole of this week, the questions coming in and the requests coming in, it's more or less like we have to extend this thing till maybe next week, Monday, Crapo. But that is my objective. I want to be able to provide you with some assistance in order for you to prepare well for your examination. So that's my objective. So if we have to extend this to next week, and how productive is it and how we are able to answer a lot of questions by students, we will still do it and make it possible for you guys in that case. So we will communicate FM. I don't know, could that be tomorrow? But we will see. We'll see what will happen. On YouTube, Pa Augustine said, can it be concluded that the policy serves as a guide in the preparation of the budget? Yes. Augustine, we can say the policy serves as a guide in the preparation of the budget of an organization. Then Augustine said, Prince, please see me after the class. Okay, I don't know, maybe he's talking about your break-even question or something like that. So maybe you guys can link up. All right, that. Let's see if I have any other thing here. There's a chart again. Two charts here. Now, Joseph Edu, sir, send a message on the WhatsApp, sorry, on the group Zoom chat. Someone makes suggestion on fixing a date for strategic case study. I believe it will help some of us. I have been observing and enjoying the session, even though I'm not writing it. The session is perfect. Just keep it up. Just keep just keep up the good work, and God will continue to bless you. Amen. And God bless you too. So certainly we will fix a schedule for strategic case study. All right. Certainly, because if we don't, some of you will not be happy. So we have to fix a schedule for strategic case study. So certainly we'll do that. Certainly we'll do that. Okay, I see someone joining now. Daniel Nye. I don't know if you have any questions. You can unmute, or your mic is already on mute, but you can ask a question if you have any questions. Okay, so I'm gonna be concluding here today for our discussion. It's been quite fruitful. It started from 4:30. It's been quite fruitful in relation to that. I know that this is something that I can do in this period of school closure, but we need to still study and prepare for the exams. That is why I'm doing this, so that I can assist you guys to prepare well for the exams. And like I said, I don't know if I said this yesterday, the ICA is still contemplating to have 2 examination sittings this year, as always. So they are still monitoring issues from directives by the presidency and the coronavirus task force team here in Ghana and all of that. So, like I said, don't stop learning, don't give up, don't be thinking about the coronavirus. At the end of the day, you must add more value to yourself. You must work on your skills. So the way you can add value, work on your skills, is to keep studying, keep studying. And aside studying for your ICA, also build a career around your skill, or sorry, build a skill around your career. That is the way I want to put it. Build a skill around your career. It means don't just be an accountant, just like that. Add some soft skills to what you are learning. So maybe you can read something about communication, something about emotional intelligence, something about human behavior, something about social media management. So do something interesting, because after this coronavirus pandemic, businesses will be employing not just on your resume, not just on the fact that you are ICA final level or ICA level 2 student. They will also look at other soft skills and other values that you can bring on the table for the company. So in as much as you are learning the ICA, you are preparing for your exams, I want you to also add some soft skills to your portfolio of knowledge, so that when you go for an interview, you're not just going to be sitting there, because chances are many interviews, they will not even ask you anything about what you think you are applying for. They will ask you something outside the blue, and if you cannot answer, you will be losing the job and you will be cursing yourself about it. So please make sure that as you are studying, you are working hard on yourself. Make sure also that you add some soft skills and do something interesting about yourself in relation to that. So I'm going to be ending here today for our discussion. It's been fruitful, but management accounting and strategic case study will return, because definitely it will return. So you stay connected. For those of you who have not subscribed to my YouTube channel, make sure you subscribe to the channel and share the video, share the channel as well with your colleagues, so we can reach as much people as possible. In case you have any further inquiry or you have anything you want to ask me, you can reach me on 050-114-9296, 050-114-9296. That is a WhatsApp as well as a call line, and you can reach us on it for any inquiry that you have, maybe for our books, for our online courses, or maybe you want to study under my mentorship, or whatever it is. You can call us up and then make any inquiry that you have in relation to that. So Thank you for your message and everything. Thank you very much for you guys. Victor said, thank you, sir, for your good work. We appreciate that. God bless you. God bless you too, Victor. Thank you for taking the time to join us. So thank you guys for joining me on the stream today. Take care of yourself. Joseph, Victor, Portia, Prince, Mike, all of you guys, thank you very much for joining the stream. And I'll see you same time tomorrow, 4:30 p.m. The subjects to be tweeted tomorrow will be communicated on YouTube, on Facebook, as well as on my Instagram pages. So you can like, follow, subscribe, wherever it is you have to do, so you will be notified about it in that case. All right. So good night and thank you for joining me. And I'll see you same time tomorrow. Bye-bye.